upper right-hand corner, and then also the full screen.
Okay, that should be good. I think that's good. Yeah, I think it's just you and I. Yeah. So yeah, so as far as mentoring goes, it's just go to the website. I just put that in the chat and click on the mentoring tab. It's just a short form to fill out. Mentoring is very versatile in that it can address specific questions or issues that you're working on, or it can look at a bird's eye view of the whole big picture. Some people just want an evaluation of, whether it's a startup plan, a business plan, or a established businesses, like maybe there's blind spots you don't see. So also mentors can help on issues that are like come and go, that you get some help and then you move on. Or if someone needs some accountability and some encouragement and direction uh, as they're building their business or launching a startup, there's plenty of people that meet with their mentor once a month for some years. So with that, I will also be putting our links for our social media links in the chat. If you are not connected with us on social media, it would be amazing if you could, and also share us. We don't want to be the best kept secret. So sharing Score with your circle of influence, people that could utilize our free services, that would be an amazing gift to someone who may benefit from those services. With that, I do want to just thank Paul Long for giving his time today and volunteering for our chapter to share his expertise. And also, everyone who has attended this today will receive the recording of this workshop. And with that, I will hand it over to you.
Well, thank you very much. Hello, everybody. Happy Monday. I look forward to talking about this because this is definitely a topic that I'm very passionate about. So as you mentioned, my name is Paul Long. I am SBA lending manager with GISA.
Things happen to prepare us before.
With GISA Credit Union. We are a Washington, Oregon, Idaho credit union based in Richland, Washington. And I've been doing SBA lending for about 15 years, and I love SBA lending. And I love watching small businesses grow from very small businesses to larger businesses. And hopefully I can help you do that a little bit more today as well. Disclaimer, there's always a disclaimer, right? Opinions expressed during this presentation are personal opinions only of moi and not necessarily those of GISA Credit Union. So this is, I would like to start a presentation with being funny. Of course, it's $1. It's a small business loan. And it probably feels that way sometimes when you're talking with a bank or credit union. But what's really important is the sentence down below. And this is something that I'm not proud of it, but it's the truth. And I'm here to tell you about the truth, right? And so it's banks lend money when people need it the least. Banks are in the risk business, and they want to make sure that they get their principal and their capital back. We don't want your assets from your business. Those are yours. What are we going to do with restaurant equipment or whatever your business is doing? We're really looking for that. So again, it's really important that you do understand that. Unfortunately, as we start through this, it's the truth. So here's some things we're going to talk about today. Type of institutions. And this is a very important thing because there are very big differences. And there are pros and cons to every single one of them, up to and including credit unions. And I'm going to be as truthful and honest as I possibly can be through this. And if you do have questions, we can definitely do those towards the end. So make sure to write those down. Things I see as a business banker. I'm going to go over really briefly types of loan programs that are out there, what institutions look for to approve loans, how a banker will look at your numbers. And I'm going to go over a very important ratio that I want to make sure everyone's aware of. And if you want to knock the banker's socks off, know this ratio. I'm going to talk more about startup financing and some financing to be really careful of. There's a lot of different things out there, and we'll get into that. Some are good, some are bad. And of course, resources, just like Score, there's a lot of resources out there too that love to help small businesses like yourself. So let's get into type of institutions. Has anyone ever seen the Umpqua Bank free ice cream truck? It has been out there for quite some time, and it's brilliant marketing. It's brilliant marketing. They show up in front of one of their locations and they give out free ice cream. Like, who doesn't like ice cream unless you're lactose intolerant, right? So there's many different types of institutions like Umpqua. And so this is what we're going to go into. Whoop. So there are multiple types of banks. There's big banks, there's regional banks, there's your community banks and credit unions, there's your finance companies and what's called a non-bank lender. And we're definitely going to go into why, most importantly, why you should care about those differences. Okay, let's talk about big banks. And I want to make another disclaimer here. Okay, I have worked for big banks. I've worked for small banks, regionals. I've done it all. I am not here to bash anybody. There are pros and cons to everything we do in life, right? And banking is no different. And so I want to go over those. So your big banks, your Wells Fargo, your Chase, your Bank of America as examples, they are great if you have transactions over $15 million. Okay, they have a lot of money. And they definitely like to get that money out there to larger businesses out there. However, they also do take more risk on smaller loans because they have so much money and so much market share. So sometimes you can get unsecured loans and lines of credit out there from large institutions. The best thing about big banks is their branches are everywhere. So if you have a cash-based business, you probably want to bank with a big bank because there's those locations that are everywhere. Now, some of the cons, you can be an account number. That does happen. Your banker changes often. You probably go into your local branch, and I've heard it all the time throughout my career. Is this a training branch? No, it's not a training branch. People get promoted. People decide it's not a good fit for them. They go out and do other things in life. Okay. Sometimes big banks are not quick on decisions. They kind of think in a box and they like to stay within the box. Sometimes interest rates can be teaser rates. So it's maybe you get a certain interest rate for 6 months, and then after 6 months, it goes up to something higher. Okay, I've seen all of these pros, cons, big banks. Let's talk about your regional banks. Your regional banks, such as Umpqua that I talked about, Heritage Bank, First Citizens Bank, all phenomenal institutions. But really what they like to focus on is middle market is what it's called, which is people that have about 10 million to 1 billion, yeah, I said with a B, in revenue. So those are not your huge loans or those huge companies like, I don't know, Amazon. Amazon's going to probably bank with a large institution. They're probably not going to bank with a regional bank. Okay. So they do focus on what they call the middle market. They want customers with larger transaction sizes, so loans probably 15 million and up. They do have semi-local decision making because they are regional institutions. And they have a good amount of branch locations, which is also really good. Cons, sometimes there's still you're still an account number unless you're a big dog. And sometimes it's difficult to talk to a decision maker if you're a true small business, and they primarily work sometimes with certain types of industries. Community banks and credit unions, I put them together because they really are more similar than they are different. So banks, if they're publicly traded, et cetera, they have shareholders. That's how they get their money. Credit unions, they're member focused. All the money that you deposit is the money that they also lend out. So there are differences. So Gisa Credit Union, Coastal Community Bank, Timberland Bank, just to name a few. Pros, they focus on the long-term relationship because a business is a very key and important business to have in a community bank and credit union. Usually you can talk with the decision maker as long as the community bank or credit union isn't too large. And they primarily work with clients under 50 million in revenue and transactions under 10 million. Okay. Cons. Well, because community banks and credit unions are smaller, they don't have as much capital as the big guys do, right? So their interest rates may be a little bit higher. They will definitely make you bring over your full relationship. So you can't really have multiple relationships around. They really do try to put those in together. And to be honest, large dollar loans can be a challenge for some community banks and credit unions when it's over a $10 million loan. Finance companies and non-banks. This is a very interesting area that has gotten larger and larger as time goes on. There's places like Ready Capital, Live Oak Bank, Lending Club, just to name a few. And just when I say finance companies are a non-bank, meaning a non-bank is they lend money, but they do not take your money. So you would get a loan with them, but you would have your deposit account with Gisa Credit Union, okay? So some of the pros on there is they can usually have no down payments for equipment and vehicles. They can do some what I call creative financing. They can make quick decisions because a lot of them are technology based. And so when you do your application online, they can spit out an answer really quick. But sometimes that is in the box. So it's really have a hard time doing that. They can take on more risk because they do, as one of the cons, higher interest rates. So that could be the case. Again, they don't really care about relationships. They care about getting the loan done and make sure you pay them every month, and that's it. And they can do some real crazy stuff. Now, I want to pause for a second. Crazy stuff can be a good thing. Crazy stuff can also be a bad thing, okay? Just because you can do something doesn't mean you should do something. So having somebody like a SCORE mentor to bounce things off of is absolutely critical. Sometimes when you get into that crazy stuff category, okay? All right. Let's talk about what's really important here. Why did I just go over that and why should you care? Okay. First of all, you need to pick what's best for you. Okay. You need to look at how you use your, do you need branches on every corner because you do take cash? Or are you a business that's all online and it really doesn't matter who you bank with? You just want a good relationship with a banker. But you can bank, through your smartphone or do anything else online because you're mostly online. Okay. What are your needs? Are you simple? Are you difficult? Do you need a lot of hand holding? If you need a lot of hand holding, a big bank is probably not your option. A smaller institution or a regional bank would be a better fit. I also want you to think about your long-term growth. Okay. There are institutions, or actually things I've seen in my career where customers have outgrown the bank. Okay. So that means that they have grown so much and have lent so much money that every bank does have a cap on how much they can lend to one individual person or business. And I've seen people where they've capped out the relationship. So again, if Amazon started with, I don't know, Gisa Credit Union, okay, let's just say, do you think we're going to be their financier in the future? Probably not, because we just don't have the money to do that. Okay. Are branch locations important? Goes back to the cash aspect. What are your technology needs? If you're just need the loan and that's it, I kind of went over some options for you there. Do you need, technology? Do you get a bunch of checks from your customer and you need a machine to run those? I don't know. What are your needs? Sit down with a banker and they can go through that with you. And like I finally said on there, do you take in a lot of cash? Because that's a really big deal. You need to be able to have those types of branches out there. All right. Things I see as a business lender. Ooh, and do I see a lot of stuff. So first, have a clear plan and resist the urge to grow too fast. This I know is difficult for small businesses, okay? You may have the plan that SCORE has helped you out with, but you need to make responsible growth. Growth takes capital and money. And if you don't have that, the business hurts and suffers. Okay. So have a clear growth plan and make sure that you are literally not just growing overnight. Okay. Especially if you're a startup business, you definitely need to start small and grow and show that your concept works. And I'll go into more of that a little bit later on. Don't buy too much too quick. I'll give you some examples here in the next couple slides. I know plenty of businesses that go out and buy 5 new trucks and hire 5 new people right off the bat. And they have these trucks expense, they have the people expense, but those people and those trucks haven't generated revenue. And see how that can take your cash. And so you really need to have that. You really got to be careful of that. As we enter 2024, and God knows whatever is going to happen in 2024 when it comes to the economy, we need to have a backup plan if business slows down. Okay. Whatever you believe of what's going to happen next year, you should always know that everything is not great right off the bat and lasts forever, right? You really need to make sure that you have some cash in the bank, that you have some protection in case something happens, business slows down, you lose a major client, all that types of stuff can actually happen. Okay. So using a line of credit properly. I want you to meet Tim at Tim's Photography, made up guy, real story. Okay. Tim has been using credit cards to finance his business for years. Okay. As a startup business, sometimes credit cards are the best way to do that. Okay. His bank told him that he could get a line of credit for his business while he was doing a transaction with the teller and the banker. Okay. Sounds interesting. Tim got a $50,000 line for his business. Way to go, Tim. Love it. Tim used $50,000 immediately to go out and buy some new photo equipment on his line of credit. Tim was making interest-only payments for a year because it was cheap. So why do you have to pay the principal back? Okay, he was just making the monthly interest because it's a line of credit, right? Tim's line of credit came up for renewal after a year. What? Lines of credit can come up for renewal, and a lot of banks can do it annually, every 2 years, every 3 years, every 5 years. But if you think you just get a line of credit and it sits there forever, that is not the case. Tim's line of credit was declined at renewal, which means they shut down his line of credit and turned his line of credit automatically into a loan so the principal can be paid off. My gosh, why did that happen? Well, so here's what I want to go over. Lines of credit. Lines of credit have variable payments because it's interest only, right? You can pay whatever you want. You can pay more than the interest, which I always encourage anyone to do, but who knows what's going on in the business life cycle and cash cycle. Interest rates are variable. That was good a couple of years ago, but now that prime's 8.5%, that kind of hurts a little bit. So they are a little bit variable. And there usually is a renewal period on a line of credit. Every institution's different, but the majority do have renewal periods. The thing you want to think about is short-term needs. Like, I need working capital because I have to pay my vendors now for my product, but my customer doesn't pay me for 30 or 60 days. What do you think that does to your cash? Okay, that's your working capital. If you say, Paul, I will pay this off in 30 to 90 days, then put it on your line of credit. That's the rule. Okay, now Tim in the last slide did not do that. What Tim should have done is said, hey, banker, or even more important, the banker should have asked what he would use the line of credit for, and then offer the proper product to do that. So if he was going to go out and buy photography equipment, he should have got a term loan, fixed payments. There's usually a fixed rate, fixed terms. It's like a car loan, right? And you know that it's paid off after 5 years, okay? Long-term needs, your equipment, your vehicle, your real estate. Guys, please do not ever put a vehicle, equipment, I mean, real estate would be a tough one, but on a line of credit, okay? Lines of credit are meant to look like a heartbeat, where it just goes up and down and up and down and up and down. That is what a line of credit looks like, and that is exactly what your bank is looking for on a line of credit, okay? What institutions look for to approve loans? The most important thing is character and the credit score. Okay, what is character? Character is have you paid your bills? Have you borrowed money and paid back as agreed? That's what a credit score is, right? That's what your credit report is. Character also is exactly what you're probably thinking right now, which is actually character of the individual. Are you a person who's extremely hardworking and will do whatever it takes to repay that loan? Or have you already had 3 bankruptcies and when times get tough, you just file bankruptcy? That's a character thing. And we do look at those as lenders, okay? Now, I can get on my soapbox and tell you all about character and credit score. But here's the thing that's important. I totally understand that people go through hard times. Medical things, divorce. I mean, you lose your car, they get their house burned down. I mean, shoot, I've seen it all in my career so far. And my heart goes out on all of those. What's important is you try to fit what you can, okay? So there are credit repair companies out there that can actually help you increase your credit score and help clean up some of those items. That means you're going to be writing a check because you're going to need to either have settlements or do anything like that to help pay off some of that old debt that's kind of haunting you, okay? Okay, everyone, print screen this, take a picture with your phone, write this down. This is a huge, important thing on this. This website, annualcreditreport.com, is the only free credit reporting agency. It's ran by the 3 credit reporting agencies. It's the only thing they share is this website, okay? You can go on, no credit card number, pull a copy of your credit report from each of your bureaus once a year. That's awesome, okay? I have it on my calendar every single year in February. I run my wife and my credit because I want to make sure that everything is what it should be on there. Is there anything that's hiding that's on there? Very important. I strongly recommend everyone to do this once a year. Credit monitoring. Credit monitoring is pretty much, my gosh, everywhere right now. Every bank and credit union on their online banking can generate a credit score for you. But can you see the credit report is the question, by the way. It gives you the score, but doesn't always give you the actual report. That's why you need annual credit report. But if you have personal credit monitoring, there's no problem with that. Keep doing that. But here's what's really important to know. Credit scores on credit monitoring are usually 20 to 30 points less than if you were at a bank or a credit union runs it. So keep that in mind because we're doing a hard pull on your credit. They're doing what's called a soft pull. Last but not least, this is a great example of of how banks look at credit scores. Credit scores can go up to about 800. It changes all the time. 850 is another, depends on what report you're looking at. The lowest you can have is 300. The lowest I've ever seen in my career is 414. That was a challenge. But really what banks are going to look for is good to great. 680 and higher is the magical number. If you have anything less than 680, there's something wrong on the credit report. There's either a current late, there are maybe your lines of credit are maxed out, all of those things. So I can, within minutes, I can look at a score and probably figure out what the problem is. But keep in mind that, again, that 20 to 30 points is different on your personal credit monitoring. Okay, we're continuing to talk here about character and business credit. Okay, this is another really important slide that I want you guys to make sure that you understand. Businesses have credit just like you all on the phone do. Okay, here's what's really important. Business credit is good to have, and it's good to have good business credit. Do not focus on it. Don't think, oh my gosh, I must go out and get a credit card or a business loan so I can build my business credit. No. Banks look at your personal credit 98% versus 2% business credit. Here's why. One, not all institutions report to business credits. Okay, if you go out and buy an auto loan today, or buy an auto and do an auto loan or do a credit card or whatever, those show up on your credit report real quick. Okay, if you do a business loan with your institution, they do not have to report to your business credit report. So what's the point of the report, right? But here's what's important. Your vendors report to business credit. So if you ever have a chance to pull a business credit report, you will find, if you're I don't know, let's just say you're a restaurant and you use Cisco Foods, okay? They're kind of one of the conglomerates. You must have an account with them and you pay them 30 days. I guarantee you that they report on your business credit, okay? Again, like I said, do not focus on business credit, focus on good personal credit. That is really the key. Anytime you establish a new business, you always get a call from Dun & Bradstreet. They are a large player in that, and they say, well, for $1,000, we can create credit for you. What? Like, that doesn't even make sense, but they call. So be aware that that always happens. And I'm not saying Dun & Bradstreet is a good or bad company. They do provide a lot of good data out there, but you should never have to pay for business credit, okay? Another thing that's interesting is business credit cards do report to business credit. So, and I say that with about 90%, okay? So make sure you are using a business credit card properly, because that is establishing on your business credit and sometimes also on your personal credit. All right. A dude with boxing gloves, okay? Why am I talking about this? I'm going to talk about capacity and cash flow. Cash flow is the lifeblood of the business. How many times have you guys heard that? Probably. But here's the interesting thing. It always comes down to tax returns, okay? Tax returns are absolutely critical. But here's what happens. The boxing gloves, one is your banker and one is your CPA. Because here's what happens. The banker wants you to look rich so you can qualify for the loan, right? Your CPA, on the other hand, wants you to pay less tax, so they find ways to take income out or to find the other deductions so you don't have to pay as much income tax. If I want you to look rich and they want you to look poor, do you see any issues with that? It happens all the time. So the reason why I say that is it's critical that you talk to whoever does your tax returns, especially if you're going to buy something large the next year. It's a relationship. It's a relationship with the banker and it's a relationship with your tax person. So make sure that they are absolutely talking together. You'll see huge benefits on that. We're going to talk to a little bit about how institutions look at you in the form of numbers, okay? So there's this thing called EBITDA. Remember I talked to you about a ratio that's really important? I'm getting real close to that, so start making some notes. But what EBITDA is your earnings before interest, taxes, depreciation, amortization. That's a bunch of banker words, okay? Let's really pin this down, and I will do that here in the next slide, okay? We can add back sometimes one-time expenses, but usually there's certain things that we look for within the EBITDA, okay? Now, sorry, I did forget this slide's out of order. I promised you we were going to go over the EBITDA and the numbers. So sorry, it's an important one. Another thing on capital. Whew, is this a pet peeve? Okay. Never go to your bank and credit union and say the following words. How much can you give me? It is the most frustrating sentence any lender can do. Okay, can hear. Because what do you think that actually means? I have no idea how much I need. How much do I qualify for? Is another thing I hear. No, you need to come to the table with, I need this. Here's my budget on why I need this. That gets you an absolute better attention from a banker. Okay. There's also another one that also gets me mad. Well, I don't want to put any money down. Well, what you're telling the banker is, hey, banker, I want you to take all the risk and I don't have to. That's what that means. So be very careful with those statements, and hopefully that also makes sense too. So when we're talking about money down, it all depends on what you're trying to buy. So maybe you're trying to buy an auto loan, or to buy a car, or a truck, or a food truck, or something like that for your business. You should always have anywhere from 10 to 20% down. Now, keep in mind, consumer loans are different. All of us can go to a car dealership and buy. But if you're wanting to do this on the business side, you need to have some money down, okay? Real estate is anywhere from 10 to 25% down. Equipment is 20 to 25% down. So you need to come to the table with some money, and the bank is there to help you with the rest of the journey, okay? Let's talk about collateral. That is a beautiful building that I'm sure any bank would love to take as collateral. I'm being very sarcastic. Obviously, that would be a very difficult piece of collateral for an institution, okay? Does the institution want what collateral you're giving, or do you have any to give, okay? Here's what's important. Banks love real estate, okay? Huge. If you have any equity in your home, that is going to be a huge deal, okay? If you rent and you're starting a business, that is where you're going to have challenges. And I'll get more into that in another slide. But collateral is an important piece. Sometimes, maybe, for example, your parents can grant their house or something as additional collateral to secure the loan. And it all depends on how much you're looking for, okay? So if you want a line of credit, for example, for your business, because it's for short-term needs, right? We went over that. What we look for as our collateral is your accounts receivable. Accounts receivable is what your clients owe you, okay? It's an IOU. We are literally going to lend you money based on IOUs from your clients. That's accounts receivables. Another way to collateralize a line of credit is hard assets. Real estate, like I mentioned, sometimes we take vehicles. If you get in a car accident, then your line of credit gets shut down. So it's not necessarily the best option for that, okay? Unsecured loans and lines are tough. Now, I say they're tough because it depends on any institution. Banks are, I'll be honest with you, banks right now are getting very worried of what's going to happen next year. So you're already going to see institutions kind of shrink a little bit and take a little bit less risk. And unsecured collateral or unsecured loans and lines is a real big deal. So just be careful that institutions are probably trying to get out of that game because they're preparing for something. Okay. All right, I want to talk about SBA. SBA is a incredible program that without this program, businesses across the United States would absolutely not have funding. Here's what I want you to think of SBA. SBA is an insurance policy. It's an insurance policy that you pay for as a part of your taxes that you pay, as well as sometimes there's a fee on the loan that's kind of like a premium. Okay. What that insures is not you or your business. It insures the bank or the institution that if your loan goes bad, we can go to the government and get up to 75, 85% of the loan back from the federal government, as long as we did what we were supposed to do. Okay. And so that allows institutions to take additional risk and loan money when they normally wouldn't, because think of SBA as kind of like a collateral. Okay. So SBA provides lower down payment options, which banks conventionally want you to put down a lot of money down. Okay. SBA cannot and will not turn you down for lack of collateral. But here's the big asterisk. Banks can. Okay. So if you do not have sufficient amount of collateral, you're still an SBA candidate, but maybe that institution will or will not allow that. Okay. That's why I talked about the different types of institutions at the beginning, is because some care about collateral more than others. Okay. SBA does lend to startup businesses, and we'll get into that. And they can use projected income to qualify. And that's definitely something you want to work with your SCORE mentor to make sure that you have your financials and your assumptions on your projections. And because that's really what a bank's going to be underwriting to. Okay. So as we talk about an SBA loan, the SBA 7A loan program is the main, we'll call it the mothership. Okay. You can buy inventory, equipment, buy an existing business, get working capital. All of those things can be done through an SBA 7A loan. An SBA loan is not for speculative investments. It is not for you to go out and start an Airbnb business. SBA won't allow that. It is not for you to go buy rental real estate. That is not what SBA is for. It's for an owner-operator business to get financing. Okay. Especially with SBA 7A loans, you definitely need a business plan and projections, and the team at SCORE is a phenomenal organization to help you with that. All right. Sorry, a lot of talking. I want to give you another example. Grow my business. I want you to meet Leslie of Leslie's Staging and Furniture. She has been in business for 3 years and has been successful. Let's define successful. Profitable. Doesn't have to be crazy profitable, but it's profitable. Okay. She needs $75,000 to grow her location, to sell the furniture that she used after the staging is complete. So she works with real estate agents, and they put in the furniture and make the house look great, sell it, move that furniture out, go use it in another house. After time, you can put it into a building and then people can come and buy it. Okay. That's what she was trying to do. Her total collateral is she had $20,000 of inventory. She had no accounts receivable, which means that there's no large clients that owe her money. And she's got a little bit of other business assets of $2,000. Again, let's look at this again. She wants $75,000 and has $22,000 worth of assets. Okay. Can SBA do this? Yes, they absolutely can, because there's a lack of collateral. This is a great example of a deal that I did about 5-6 years ago. I did the SBA 7A loan for them, $75,000. We did it on a 5-year note. The business grew and is still successful today from that loan. Okay. This is a great example of an SBA loan. Now, here's where I'm going to get banker mathy on you. And this is where I bring in EBITDA and I discuss that. Okay. This is how institutions look at your number. I am not going to do a full underwriting here on this call. That is not what I'm trying to do. But what I want you to do is I'm going to share with you the things that I look for. And for you, when you go to your institution to apply for a loan, man, am I telling you, if you have some of this information and you know it, it's going to be a real big deal. I'm sure you all have watched Shark Tank. And those people that don't know their numbers get crucified by Mr. Wonderful, right? I don't want you to have that experience at your institution, okay? So let's talk about Paul's Guitar Shop, okay? This is a balance sheet, okay? The things I have circled are the items that I immediately look for on a balance sheet. This is a business balance sheet. First thing I'm going to look for is cash. Do they have any? Okay. And the amount of cash you have is completely dependent on many different factors. But all what I'm looking for is there cash there? Okay. I have seen balance sheet where the cash is negative because their QuickBooks hasn't updated. And that's never a good sign. A balance sheet should never see negative numbers. There's one area where it's okay, but you should really never see negative numbers on a balance sheet. Okay. I'm going to go down to long-term assets. I want to see, what do they have in assets, in items, things that they've bought. This is in this case, you have leasehold improvements of 100,000. So they must have redid something within their building. They, redid bathrooms and showroom or whatever the case is. Okay. So you'll notice there's depreciation. Ooh, that's a negative number. That's the only place a negative number is good on a balance sheet. Okay. So because you never pay for depreciation. So you have 100,000, you have the 2,000, you have 98,000. Okay. So you have $98,000 worth of assets. Okay. Now I'm going to go over to liabilities. You have 99,500 in long-term liabilities, also known as debt. You have debt for $99,500 and you have $98,000 in long-term assets. Okay. So it's short about $500 in this case, right? That may be okay. I don't know the status of it. Maybe it's to buy a business. They used an SBA loan clearly, but that's the thing that I'm looking for. Another thing I look for is total owner's equity. Okay. This owner's total equity is probably one of the most important things on a balance sheet. Okay. That number must be positive. If that number is negative, the piece of paper is telling you that the business is not worth anything on paper. Okay. You may still have other assets, but on paper, your business isn't worth anything. In this case, this business is worth $21,950. Okay. Now, that doesn't mean you're going to go out and get an appraisal on the business and it'll come in higher. Okay. But it's important for you to understand that these are the key things on a balance sheet that I look for. Okay. This right here is the cash flow example. This is the ratio I want you all to know. Okay. Very important. And if you have this in your projections, or if you have this you know the numbers when you go in and talk with your banker, it goes a long way. So remember, we talked about EBITDA at the very beginning, earnings before interest, taxes, depreciation, and amortization. That means, let's look at your profit and loss statement from QuickBooks. Okay. You're going to immediately look at the bottom. In this case, it shows 100,000 in bottom line earnings. Okay. That's your earnings of EBITDA. Earnings before interest, taxes, depreciation, amortization. So what that means is we look at your tax return and we add back interest expense. It's interest that you have paid to the institution. And you'll see why we add that back here in a moment. But what's important to understand is we add that back. Okay, so the bank gives more money on cash flow. Depreciation. Every asset gets depreciated. Every asset gets depreciated on your tax return. It's a write-off. But guess what? You never wrote a check for depreciation, did you? So we actually add that back. Amortization is just like depreciation, but it's usually on like fees is normally what that is. And so we add that back too. So what that means is we turned $100,000 plus 8,000 plus 30,000 plus 700 into 145,000. So in this hand, you have $145,000. Okay. Now let's look at the other hand. The other hand, so that of that 145,000, that is how much money you have to pay debt. Okay. So now let's look at another example here. Let's say, for example, you have $3,000 a month in debt payments. Okay. Maybe it's a credit card. Maybe it's an auto loan. Maybe it's another loan, whatever the case is. Okay. You take the $3,000 per month and you put that into an annual figure. So you take this times 12, you get 36,000. Okay. So 36,000 a year in debt payments. Now we're going to look at the loan that you want from me. That new loan payment is $750 a month times 12 is $9,000 a year. So in this hand, you have $145,000 to pay debt. Okay. In this hand, you have $45,000 in debt, 36,000 plus the 9,000 in your new debt. So you made 145,000 this year in this. You have 45,000 in debt. You divide those two numbers together and you get what's called a debt service coverage ratio. In this case, it is 4.22 times. What the heck does that really mean? That means you can afford your loan payments 4 times its amount. Banks and credit unions look for 1.25. Can you afford your debt payments at least once? If you can't afford your payment once, you're automatically underwater, right? So banks are looking for 1.25. They want a little bit of cushion in there, right? 4 times debt service is a no-brainer for a lender, okay? 2 times debt service. Anything above 2 is a no-brainer, okay? But banks are looking for 1.25 or better. This is a very important piece that I want all of you guys to have in your business and make sure you understand that number, okay? All right. As we're wrapping this up here, we're going to talk about startup loans, okay? So, as I'm sure many of you probably know, getting a loan for your startup business can be a huge challenge, but it is possible, okay? Startup loans can be used, of course, for equipment, working capital. I put in here real estate, but it's pretty rare that you would want to buy a building and start a business at the same time, because we want to make sure that your business is sustainable for a couple of years before you go out and buy real estate. So you lease for a while, then you grow into your building, okay? So as we're talking about this for startup businesses, you can get loan amounts up to $5 million, but hold on a second. If you think a bank's going to give you $5 million for a startup, I dare you to challenge me on this, okay? It's very, very, very hard, almost to the word impossible. The SBA's average loan amount, not just for a startup, but even for an existing business, is $337,000. Okay, so keep in mind what you're asking for should be closer to the SBA loan average. Okay, You can have loan terms up to 10 years for working capital, 10 years for equipment or whatever its useful life is. So if the useful life is 5 years, we're only going to lend you up to 5 years. We're not going to lend you more than the useful life. And we'll lend up to 25 years on real estate. Startup loans. Remember, I'm talking about startup loans here, okay? The loan must be collateralized to the fullest extent possible. Now, remember I said SBA will finance startups, SBA will do this, and SBA will do that. But you got to find an institution that's willing to do a startup loan with little to no collateral. And that, ladies and gentlemen, is going to be the biggest issue that you probably run into and possibly bang your head against your desk because of whatever that is, okay? If you have equity in your home, it will go a long way, okay? It's very important on there. A personal guarantee is always required, okay? If you have 20% or more ownership in the business, you are going to guarantee the loan, which means you are going to sign on the line. And if you don't pay, the bank will come after you personally, okay? We put a blanket lien on all assets of the business, okay? So what we do is we literally put a blanket over your business and all of that is collateral. So the keyboard here, my mouse, my desk, all of that is the collateral for my startup loan when looking at a startup loan, okay? Interest rates on a startup loan are high, okay? No matter where you go. I'm talking no matter where you go. Interest rates are based on prime. Prime is now 8.5, ladies and gentlemen. That's a really big rate. Used to be down in the 3s. We're now at 8. And SBA can charge up to 6.5% on top of prime rate. We're talking the teens in interest rates, okay? It's based on the loan size, the risk, and loans are generally variable rate. Very rarely will you get a true fixed rate on a startup business loan, okay? Other things to look for in order to really make sure that the bank looks at your startup loan request. You need to come up with at least 15% or more down payment of your overall project. So if you're coming to the table and you say, Paul, I need 2 pieces of equipment, I need some working capital, I need some inventory, and I need $300,000. $300,000 is my total project. You need to have 15% on 15% of that 300,000. Okay, that's what you need to bring to the table. If you have less than that, it's going to be a real big challenge. You need to be, and again, this is in order to really make sure on those startup loans, try to get to full collateralization to SBA standards. That is, what you're offering as collateral is equal to the loan amount. Secondary income from the guarantors. Man, have I made decisions in my years of doing this, specifically based on secondary income. Secondary income is critical for a startup business because as you're growing it, if you're working at Amazon or who knows where you're working, but having that job is critical because you can take some of your personal money to feed the business and you're not always relying on an institution, okay? Startup loans, remember I talked about 640, 680 is okay on credit for an SBA loan. For a startup, you better have 700 plus. If not, it's going to be an extreme challenge for you. No bankruptcies, no judgments. You need to have positive net worth. And so when there's a personal financial statement that you always fill out, and that actually says, based on your assets that you have individually and the loans you have individually, do you have more assets than loans? That's what we're looking for. We need a positive number. And of course, a business plan with 3 years, financial projections and assumptions, okay? Assumptions, what do I mean by assumptions? If you look at your projections, and you say my gross income is going to be X, You need to say in a column right next to it, how you came up with that number. I'm selling 15 haircuts a day at $25 each, Monday through Friday. Like that's an example of an assumption. And on your projections, every line item for every income and expense needs to have a description of how you came up with that number. That's assumptions. Woo! It's a lot of stuff, right? So the last thing that I'm going to get into here is some financing to be very careful of, okay? Again, I'm not here to pick on institutions. I'm just telling you the God honest truth of what's out there, okay? There are companies out there that literally will give you the money what you want, but you may have weekly payments. You may have an interest rate that's 20 to 30%. That's not going to help your business, right? If cash flow is king, that's the one thing. This right here is always my favorite because we have good, cheap, and fast, right? You can never have all three. It's impossible to have things that are good, cheap, and fast. If you have it good and cheap, then it's going to be slow. If you have things that are good and fast, well, it's going to be expensive. And if you have things that are cheap and fast, it's probably low quality. Okay. Same thing with financing. Okay. There's also things called factoring, where they take your invoices that customers owe you money and provide financing to you directly on that specific invoice. That's called factoring. It's definitely kind of a last resort, but that is on there because let's say, for example, you have a customer that owes you $100,000. Okay. You can say, here's the invoice, factoring company, give me the money. I need the money now. Okay. They'll give you 80% of the invoice. Aren't they generous? They take 20% for themselves. You get $80,000 and then you're done. You don't have to worry about that invoice ever again, but it's a very expensive way of financing. Okay. Hard money. Hard money is very big out there in real estate. And these are just, frankly, rich people who have cash. They will invest in your business. They will invest in your real estate. They'll do whatever to give you the money. If you don't pay, they take your collateral. It's like a bank, but it's just with a person. Okay. A great example of this one is Steve at Steve's Transmission. Okay. He had a commercial building worth $900,000. Good for him. He owes $200,000 on the building and his note is due, which means the bank says, hey, it's the end of your cycle here. We need to renew it. Okay. Your note is due. Been a successful business last 50 years, solid cash flow, but he's not paying his bills. It's pretty crazy. Oh, he owes $75,000 in back taxes. You think banks like that? No. He has 2 months to pay, or the business and the building are being taken to pay the tax debt. The bank said no. Shocking, right? Because that's a really big deal. But here's the thing. This is where hard money helps. A hard money, this should be hard money, not had, or yeah. So that hard money broker did a loan for $275,000. They refinanced the building and paid the taxes at a 15% rate. And it was a 2-year term, which means in 2 years it needed to be paid off. The bank, which I did this loan, we ended up refinancing 2 years later once the dust is settled. Hard money has their purpose, but it's a short-term solution. Merchant cash advances are another one that if you use your credit card machine or to pay, you can have loans against that. That's definitely something that can be expensive. Angel investors sound great in theory if you can actually find an angel to invest. And again, same type of thing, kind of like hard money. It's a high net worth individual who provides financial backing for startups. Okay. Last but not least is your resources, guys. You know about Score, utilize them. They are worth their weight in gold. Okay. And as we finish up here, my final suggestion is that as this is a bar stool, you need to make sure that there's 4 legs on a bar stool, and you need to make sure that you have proper representation on that. And if one of those legs goes away, the stool falls. You need to have a good insurance agent. You need to have an attorney. Yeah, I know they're expensive, but you need to have one. You need to have a good banker, and you need to have a CPA and accountant. Okay. All right, guys, here we are. I know I went over a lot of stuff, and I'd like to open up the floor for questions. Rock and fire. Unmute yourself, ask away.
I'm sorry, you said attorney, insurance, CPA, accountant, and what was the, finance person.
Yeah. Well, and it's not just finance. It's a banker. Yeah, they can do finance, but they provide a lot of value in the form of education of financing options. Okay. Great question.
And then one more question. You mentioned that for the startup, there seems to be more requirements or stricter requirements.
Yep.
Than a small business.
Mhm.
I guess how does the bank determine one from the other if you're starting, I guess, from scratch in both cases?
Great question. Great question. And I need to add that to my presentation. So thank you. The magical number is 2 years. And I'm sure many of you guys have heard this before. You need to have at least 2 years of business. And then all of a sudden, it absolutely opens up the floodgates. Because what you need to do really for the first 2 years is you need to put in your own capital. You need to put in your own credit, your own everything to test the process, right? We're in the risk business. So if you've been around for 2 years and you have success, then we're going to lend. That's the small business loan versus a startup loan, which I said is hard because it's driven more towards you using your personal assets, credit, and cash to fund your business. Does that answer your question? Does that answer your question?
Yeah, sorry, I couldn't find the.
No, that's fine. I just want to make sure I'm answering it. All right, Ramiro. And I have one in the chat too.
Yes, thank you, Paul. So personal guarantees, in which scenarios? I mean, I understand that from a banker's point of view, I mean, you will secure the loan as much as possible, right? So to lower the risk. From an entrepreneur point of view, you want to do the opposite. So,
100%.
Yeah, so therefore, if I ask you not for the banker's position, because I already know that, but
Sure.
not for the banker's position, from an entrepreneur point of view, in which situations can we as entrepreneur can think of, not having to give a personal guarantee? If you can touch upon startups compared to buying existing businesses and so on and so forth. If you can share a little bit of that, that would be great.
So looking at personal guarantees, that is a phenomenal question, and it's a battle all the time, okay? So when you're looking at on a personal guarantee, you want to put the risk on somebody else, okay? So I'm going to be in your shoes. I need money for my business, and if the business fails, I want to be protected, okay? And when on a personal guarantee, you are saying, I, Paul Long, am certifying this, that if I don't pay, then you're going to come after me. You're going to ruin my credit. You're going to do that stuff. Okay. That's a personal guarantee. If you're not willing to put a personal guarantee, the bank, you are literally telling the bank, I'm going to take a risk. I don't know if it's going to work, but I want you to take more risk than me as the entrepreneur. And that ain't gonna fly. Okay. In that case, it's a one-sided relationship. Okay. Because it's a startup. So startups, you will always have a personal guarantee. I literally cannot even possibly think of one exception to that rule. And that's the risk you take as an entrepreneur, is getting that financing, because you are really taking the risk on, is the business going to work? Does that answer your question? Didn't
Yeah,
say
what about buying an existing business?
Buying existing business, personal guarantees are required. Because again, you are, even though you're buying an existing business, you are the person that writes the checks. You are the person that makes the decision. That's why the personal guarantee is required when buying an existing business.
So in which situation then can you get away with not having to have a personal guarantee?
Until you're the size of Walmart, personal guarantees will always be there. There are some, let's say for example, you're going to go buy a truck, brand new truck, at the local Ford dealership. Okay. They have options that will lend to the business, no personal guarantee. What do they have as collateral if you don't pay? The truck, right? That is more where you could possibly find a no personal guarantee, is in a case like that. But if you're going to buy a business, I need working capital, I need a line of credit, I need something like that, unless it's fully secured by real estate, a piece of equipment, a personal guarantee is always going to be required.
So if I'm, for example, if I want to buy a small fleet of cars, and I'm not a Walmart size.
Sure.
So, and I tell the bank, hey, you can collateralize the small fleet, but I'm not willing to put a personal guarantee. Being a small operator, is that within the realm of possibilities, or that's completely impossible?
I'm not going to use the word impossible, because there is lending out there that will absolutely do that. Finding it, I wish you the best. And if you are truly looking for a fleet of vehicles, I would honestly tell you to create a relationship with a finance person at a car dealership and see what options they have for that requirement. That's where I would start.
Thank you, Paul.
You bet. There is a couple in the chat. Brent says, can you give a quick recap of 1, the SBA 504 loan program, and 2, the express line of credit? I didn't cover those. You're absolutely right, Brent. Thank you for sharing that. 504 loan program is another SBA program that's really driven towards real estate. If you are wanting to buy a commercial piece of property and you are going to use at least 51% of the building for your business, that is a phenomenal program for it. I use it all the time. So 504 is really driven towards real estate. SBA Express line of credit. SBA Express line of credit is just like the 7A program, but it's meant for lines of credit. So you can get an SBA line of credit for 50,000, 100,000, whatever the case is. You can go up to 500,000. And then the bank gets a guarantee. But here's the thing that's really interesting on those. I do them all the time, but rather than having a 75 or 85% guarantee if you don't pay on an SBA Express line of credit, I only get 50. So I'm literally 50-50 in with you that if you don't pay, I take a 50% loss. Okay. That's the SBA line of credit. They're phenomenal tools that are absolutely used, but it all depends on what you're going to use it for, just like I talked about. Okay. Hopefully that answered your question there, Brent. Next is Deborah. Can you go over the 4.22 and how you got there? Yes, I absolutely will, because it's so critical. Let's see. Aha. Take a picture with your phone, Deborah. So the biggest thing is you take your bottom line earnings from your profit and loss. You add back interest, depreciation, and amortization if you have it. Remember, that's in one hand. In the other hand, you take your monthly payment times 12 on all of your debt, as well as your new debt. And then you divide the two numbers together on an annual basis. So you take that 145,000 and divide it by the 45,000 to get the 4.22. Take a picture of the screen. This one will help you out.
Got it. Got it. Thank you so much, Paul.
Wonderful. Good. Thank you. Question came in. So it's best not to have debt when starting a business. I'm trying to buy a semi, but I really can't find correct numbers to show how much I need to make on average. Okay, so yes, it is ideal that you don't have debt for a startup business. Okay, that sounds great in theory, but the execution is it's difficult, because if you're wanting to buy a truck in this case, is it a truck or am I making that up? I'm trying to buy, buying a semi. Sorry. If you're trying to buy a semi, you need a loan, okay? But what you need is a down payment for the loan, okay? That's where 10 to 20% is a good recommendation for that. If you don't have the 10 to 20%, it's going to be hard, okay? That's also where, and I strongly recommend this, if you're looking to buy any sort of vehicle or semi, you need to go to your local Kenworth Mack dealer and talk with their financing department, because they have even more programs than banks and credit unions do. So I would start there on the semi. As for finding the correct numbers to show how much you're going to make, that one's a tough one. That one is a real tough one, because that is, it all depends on what you're hauling, right? Especially as a semi. Are you doing port business? Are you doing long haul? Are you doing short haul? Are you doing same day? All of that plays into a factor. And this is definitely where your SCORE mentor does have resources that can help you go through that. Okay, so good luck with you on that question. And another one just came in, and I'll get to you, dear Romero. Would it be best to do an LLC or just personal credit? Okay. Now, again, guys, I'm not a lawyer, but you always need to protect yourself. Always. So as a sole proprietorship, you have no protection as a business. Do I recommend that you start an LLC, a corporation, or whatever? I'm not giving tax advice, but what you're doing by creating a separate entity from a legal risk. Okay, so let's say, for example, it's the semi business. Okay, and you're a sole proprietorship, and you're driving down the road, and I jump out in front of you. Okay, you run over my leg. Okay, I'm going to sue you, probably, right? What am I suing? I'm suing you personally, because your business is under the personal. As an LLC, if I did that, I would sue the LLC, not you personally, because there's what they call the corporate veil between that. So it's from a liability risk standpoint. I'm not an attorney, I'm not a CPA, get proper legal advice, but that's the reasoning for it. Okay. Romero.
Yes, thank you, Paul. So question about personal credit score. How much can we leverage that in the following scenarios? Think of a 2x2 matrix, right? Where on one side you have for SBA compared to non-SBA loans. So how much can we leverage a personal credit score? So and then on the other axis you have startup or buying an existing business. So is that, let's say for example that my personal credit score has been 840 for the last 10 years. Is that something that is going to get me anywhere in terms of negotiating anything, or is more of a nice to see type of thing?
That's a great question. I like how you presented that as well. 800 for a startup, critical. 800 for a business to acquire a business. I mean, an 800 credit score opens doors. A 700 credit score opens doors. A 640 credit score closes doors. A 680, some are open, some are closed. Does that make sense? So it is important, and even for startups or for buying existing business, yes, it's very much important, but it all depends on how many doors you have open. Does that kind of make sense?
Yeah, but the question is more around, it opens doors, but at the end of the day, can I negotiate anything with it or not really? It's more like, okay, welcome. Here is the list of requirements. That's it. As opposed to, hey, 800 plus in the last 10 years. Therefore, let's negotiate collateral, let's negotiate interest rates, or let's negotiate personal guarantee, or let's negotiate secondary income source from that list of requirements. Is that something you have seen or not at all?
Not really, unfortunately. The Yeah, I know exactly where you're trying to go. Having a high credit score, it's important, but it can't necessarily be used as a negotiation tactic. And I think that's where your question is, if I am making sure I understand it right.
That's correct.
Yeah, I'm sorry. I just preached the truth.
Okay, thank you.
Another question came through the chat. Can a property in a trust be used as collateral? Whew. God, have I done that before? That I needed a beer after that one. Yes, it can. It all depends on what kind of trust it is. It depends on what the collateral is. It depends who's in charge of the trust. Is the trust willing to grant the collateral? That's usually the biggest thing. But can it be used for collateral? Yes, it can. Will it give me more gray hair? Absolutely, it will. What else? I'm an open door. Oh, awesome. Well, that is, oh, Romero?
Yes, when buying an existing business,
Mhm.
as opposed to a startup, when buying an existing business, how important is to have this secondary income from a guarantor point of view? So, or will the cash flow of the business be way more important?
The cash flow of the business is way important on buying an existing business. Absolutely. Let's say, for example, your debt service coverage, and just in the example, the slide, excuse me, that's on here, if you're on the 1.25 side of this, you better have outside income. If you can afford the payments based on that's projected or based on its income it's historically done, and you're at over 2 times, I'm going to care a whole lot less about the secondary income. Risk.
So that when you negotiate the price of the business you're going to buy,
Yes,
to reach that 2+ ratio.
absolutely. Because you're not going to buy a business that doesn't cash flow. Why the heck would you do that? And that's where the 1.25 comes in. That's why this cash flow example is so critical.
Thank you.
You bet. So a home, let's say, can remain in the trust. Absolutely. Yes. So you can keep that protection and everything that a trust does. Yes. Another one in the chat. When does a business owner or type of industry will need to put their home as collateral for an SBA loan? Well, Nancy, all the time. Here's really the thing. The official wording of SBA is the loan must be fully collateralized to the fullest extent possible. If you have equity in your home, that must be taken to collateralize to the fullest extent. That's the issue. So, and again, just to kind of, and I forgot the other person that mentioned that's trying to, that mentioned about, you're trying to protect your personal assets. You're trying to protect yourself, right? You're putting your frigging home on the line, right? That's a big deal. But it shows you're committed to the loan, and that goes a long way. That goes a very long way. Yes, regardless of what entity the business is under, you can be sole prop, what LLC, corporation, partnership, whatever. Home gets taken. Yep. That's a kind of a downfall on SBA lending, but what else is gonna You know, I do a ton of business acquisitions. When you're buying a business for, let's say, I don't know, $500,000, you're not getting $500,000 worth of assets. You're getting probably, I don't know, 100, and I'm financing 400,000 in goodwill. How do I repossess goodwill? I can't. So that's why we need collateral to make the lender feel better and an SBA guarantee. SBA loan collateralization to the greatest extent. In the absence of real estate, can we offer securities portfolio? Ooh, SBA used to do that. And then the market started to turn, and then SBA said, no, thank you. The only requirement that they have is taking any available equity in real estate, whether it's an investment property or your own home, as collateral. So in this case, in this question, that would be an example of a good to have, but the chances of a bank actually taking that is probably under 5%. And I agree with the sad face. I totally agree. Because you're right, it does have assets, but it all depends what it is. Do you have a bunch of Amazon stock, or do you have a bunch of Enron stock? Two totally different things, right? How about cash in a 401k? Another great one. Paul's personal opinion: don't take money out of your 401k to start a business. I'm sorry. I may make people mad by that. That is your retirement. And I understand that you maybe want to start a business with it, but it's your retirement. Don't take your retirement. However, I will give one asterisk on this, and to answer this question from you. There are things what's called a ROBS program, ROBS program. Throw it in your Google. And it is a program that allows you to borrow against your 401k to start a business. It works. I've seen it done. A lot of people do it. It's expensive to set up. You have to set up a C corporation, because remember, C corporations get double taxed. And to set up a C corporation there's a lot that goes into it. So you can borrow against your 401k using this ROBS program to do that. That could be an option for some people. ROBBS program. Guidant Financial is who I work with. So that could help you out with that. And again, you're borrowing against it, which, are you taking the cash out? No. Penalties. There's pros and cons to everything, right? Just like I was saying. Any other questions before I wrap this up? Before we do, I want to let you know a couple things. There is, sorry, let me go all the way through. Just as we're talking about as additional resources and such, I do want to give you my email address. I do have my phone number there too. Email is the best way to get a hold of me, and it just really is. I have a team of 10. It's a lot. I do primarily service Washington, Oregon, and Idaho on there. But one more thing I just want to make sure to add, just kind of as a personal comment on here, is I am so dedicated to small business education that I actually created a website where I go over many of these topics that I talked about. It's my name, Paul T, in my middle initial, long.com, paultlong.com. I have videos on every part of buying existing business. I think Romero would love to see that. Buying real estate, the different SBA programs. And it's not a matter of with Gisa Credit Union. It truly is me sharing the information like I am. So it's paultlong.com. It's a free resource. I don't charge. I just want to give the information. I want to help people out. Romero.
Yes, thanks, Paul. So another question is, where do you suggest us go to learn more about asset-based lending. So typically that is, I've heard that more on the real estate world, but imagine, you know, a car or a truck fleet, or imagine a business that is worth more, but for whatever circumstances you are able to negotiate the price down.
Yeah.
So where is that something that is more, hey, it's extremely difficult to find, it exists, but it's more a personal relationship thing? Or is this something that I can find somewhere if I put the time?
I could help you with that one. I don't specifically do that type of thing at GISA. I actually am thinking of a person that I've known for a while that does those types of things, and I'd be happy to do an introduction and see if it's a right fit for you. If you shoot me an email to the email address on here, just say, hey, give me your asset lending guy, and I'll be more than happy to do an introduction for you.
Awesome, will do. Thank you, Paul.
My pleasure. All right, well, I want to thank everyone for their time, and I'm going to pass it back over to our friends at Score. I think. Well, here, then I'll go ahead and I'll finish it up. But I just want to say again, thank you very much for allowing me to be on here. And thank you to Score. Score is a phenomenal organization, guys. I work with them quite a bit in all parts of the state of Washington. They are a phenomenal resource to really help you. And my gosh, guys, the price is free. It's free business advising. They will help you with your projections. They will help you with the troubles that you have in your business, because your Score advisor is and was a business owner themselves. That's what makes Score special. So I do encourage you to go to the website, and it is yeah, it should be clickable on there, hopefully, or maybe it's just my computer. Just put in your zip code and they'll be able to help you out on there. And last but not least, we love feedback. Give us feedback. You can tell me, you know, hey, Paul good, Paul bad, doesn't matter. I just want to be able to help you guys out, and Score wants to hear that. So ch.admin0180@scorevolunteer.org. Feel free to send in an email. I do this for free. I don't get paid for doing this. I just like giving the information, guys. So I want to thank you all for being in attendance, and have a great rest of your Monday.
Thank you.
You bet.
Thanks, Paul.
You bet.
Thank you again, Paul. You're amazing.
Thank you, Deborah.
Like, I'd love to have you come speak. You want to come to Arizona?
I love Arizona. Don't tempt me.
And you're so enthusiastic. So do we get a copy of your anything?
Yeah, so once everything, once we end the chat, a video gets done, and then you can send an email to the same person you registered for, and then they can send you a copy of the entire presentation.
Super, because I'm at the SBA and I'm in rural, middle of nowhere, Arizona. And all my businesses are new starts.
I get that all the time from Score and SBDC individuals. It's hard. It's so hard. And just like I was going through on the presentation, it's
tough. It's tough. And our other big community, of course, is the Navajo Nation. You want to talk tough? Have you done any work on a reservation?
Oh my God, it makes SBA look like a cakewalk. No,
we have 150,000 Diné in an area as big as Massachusetts. There are 6 banks.
Oh.
There are no addresses.
What? Oh my God.
You can't even start a
Oh,
business. You can't even start a business and there are no addresses.
how do you collateral? Like, I'm just thinking all I mean,
You can't collateralize anything because they're land grants. They're owned by, the land is all owned by the US government.
you can always
And
do
these
that
were
building
issued,
up.
yeah, these were issued in 1850 something, where the one male heir was good to go. Well, fast forward 150 years, each one of those leases now has 150, 200 people that must agree 100% on how to use that land.
Good luck. Good luck.
Now we bring them all into town. We get them businesses in town so they have a town address.
Oh
And
my
they don't register their businesses on the Navajo Nation because it's too hard.
Well, and then I know there's like, yeah, and there's just, they just want to do all the funding on there. Like, God, how do you help them? Like, that's just
It's
You-
so hard.
almost impossible.
It's really, really hard. They have some grant money, especially with the COVID money.
Yeah.
But I'm basically, how I help is I'm setting up my program for next year to go into the communities with a bunch of computers to actually help people write business plans, because we have people who can't write a business plan. No way. So that's how I help people.
Bless you. Did you know that before you signed up?
Well, I mean, I knew it was complicated, but the
Sure.
more I learn, the worse it gets.
I bet. I bet. And well, I wish you the best on that. That is for sure.
Well, Paul, you're amazing, and thank you again for your time now,
My
and
pleasure.
blessings to you. You ever come to Arizona?
All right. You got it. That'd be actually really fun to see.
Come on down.
Thank
Thank you,
you.
sir.
You bet.
Bye-bye.
Bye-bye.